Hello everyone. We have been discussing the IFRS 15 revenue from contract with customers, focusing specifically on the principle-based 5-step model for revenue recognition. We are currently on the step 3 of this model, which involves determining the transaction price. To recap, in step 1, we identified the contract with the customer, and in step 2, we identified the performance obligation in the contract. Now in step 3, we need to determine the transaction price of the contract. In our last lecture, we defined the term transaction price as the amount of consideration that an entity expects to be entitled in exchange for the goods and services to the customer. And there are 4 factors that can affect the nature, timing, amount, and the extent of transaction price. These factors are: number 1, variable consideration; number 2, significant financing component; number 3, non-cash consideration; and number 4, consideration payable to the customer. Today, we will focus on the first factor, that is variable consideration. We will discuss about how we can determine the transaction price in cases involving the variable consideration. First of all, let's talk about variable consideration. As the name suggests, variable consideration refers to the portion of your transaction price that is not fixed but variable. And this variability depends on some future events or occurrence. If any component of our contract transaction price is contingent upon a future event, we call that portion the variable consideration. We encounter numerous examples of variable consideration in our practical life. For instance, imagine I am a contractor who constructs buildings, factories, or industries, and suppose I receive a request from a customer to build a factory from them. We agree on a contract price of $10 million with a condition that I must complete the construction within a specific period, let's say 6 months. The customer also informed me that if I fail to complete the construction within this time frame, they will deduct a penalty of $500,000 from the contract price. So even though the initial contract value is $10 million, but if I don't meet the deadline, I will only realize $9.5 million. Now, as a contractor evaluating the transaction price of this contract, the initial price is $10 million. However, out of this $10 million, only $9.5 million is fixed consideration. Regardless of whether I complete the contract on time or late, I will recover $9.5 million from my customer. Therefore, the fixed consideration for this contract is $9.5 million. And the remaining $500,000 represents variable consideration. If I complete the contract on time, I am entitled to this $500,000. But if I fail to do so, I won't be entitled to it. Thus, this $500,000 portion of the transaction price represents variable consideration, contingent on whether we complete the contract on time or not. This example illustrates a penalty, but as we dive further into this topic, we will encounter multiple examples of variable consideration in practice questions and scenarios. Variable consideration is the amount of component of our contract transaction price that is not fixed, but dependent on some future event or occurrence. Examples of variable consideration include discounts, rebates, refunds, concessions, incentives, performance bonuses, penalties, and contingent payments. While these examples may have different names and description, they all represent variable consideration in concept. IFRS 15 states that if there is any variable consideration or if there is any variable component in the transaction price of our contract, we must estimate to what extent we are entitled to this variable consideration. The standard specifies that if the consideration promised in a contract includes a variable amount, an entity must estimate the amount of consideration to which it expects to be entitled in exchange for transferring the promised goods and services to the customer. When estimating variable consideration in our contract transition price, we have two methods. Number one, the expected value method, and number two, the single most likely amount. We will use either the expected value method or the single most likely outcome method to estimate our contract's variable consideration. Expected value method involves determining the probability weighted amounts within a range of possible outcomes. It is typically used when there are large number of similar contracts. For example, if we have several contracts with different potential outcomes, we assign probabilities to each outcome and calculate a weighted average. This gives us an expected value that reflects the average consideration we expect to receive. On the other hand, single most likely outcome involves identifying the single amount within a range of possible outcomes that is most likely to occur, and it is usually used when there are only few potential outcomes to consider. For instance, if we have a contract with one primary variable component, such as performance bonus, we estimate the most likely amount that we will receive based on our assessment of the likelihood of achieving the performance target. When estimating variable consideration, IFRS 15 provides guidance on two methods, the expected value method and the single most likely outcome method. Let's understand when to use each method and how to apply them with an example. Imagine I am a contractor with a contract worth $100 million to construct a factory. According to the contract term, there is a fixed consideration and I am entitled to fixed consideration of $100 million upon completing the construction. And number two is the performance bonus. If an independent engineer rates my construction as best, I will receive an additional bonus of $5 million. And there is also a penalty for delay. If I do not complete the construction within 6 months, I will incur a penalty of $50,000 per day for each additional day of delay. For instance, if there is 1 day delay, $50,000 will be deducted from the consideration. If there is 2 day delay, $100,000 will be deducted, and so on. In this scenario, we have two variable consideration. Number one is the performance bonus and number two is the penalty for delay. For the performance bonus, there are only two possible outcomes. Either the construction is rated as the best, entitling me to the $5 million bonus, or it is not and I do not receive the bonus. To estimate this variable consideration, we would use the single most likely outcome method. This involves assessing which event, receiving the bonus or not, is most likely to occur. For example, if there is an 80% chance of receiving the bonus because our construction is likely to be rated as the best, then we would include this variable consideration as a part of our transition price. On the other hand, if there is 80% chance that we won't receive the bonus because our construction would not be rated as best, then we will exclude this variable consideration from the transition price. Here, there are only two outcomes. Either we achieve the best performance and receives the bonus, or we don't. Therefore, we use the single most likely outcome method for estimating this variable consideration. For the penalty clause, the situation is different. Here, the consideration is reduced by $50,000 for each day of delay, and there can be numerous possible outcomes: 1 day delay, 2 day delay, 3 day delay, and so on. each additional day of delay result in the reduction of $50,000. In this case, because the number of potential outcomes is numerous, we use the expected value method for estimation. This involves calculating the weighted average consideration for each possible outcomes based on their probabilities. For example, if the probability of 1 day delay is 10%, 2 day delay is 15%, 3 day delay is 30%, and 4 day delay is 20%, we would calculate the weighted average consideration as follow. Expected penalty would be $50,000 into 10% plus $1 lakh into 15% plus $150,000 into 30% plus $200,000 into 20%. By using these probabilities, we calculate the expected value of the penalty, which gives us a more accurate estimation of the variable consideration. And this approach is similar to how we estimate provisions under IAS 37. Under IAS 37, we also estimate provisions using these two methods, the single most likely outcome or the expected value method. For example, if our lawyer tells us that there is 70% chance that we will lose a court case and a 30% chance that we will win, we consider the event with the highest likelihood. If we believe there is a 70% chance that we will lose the case, we record a provision using the single most likely outcome method. On the other hand, if our lawyer informs us that we are likely to lose the case, but we will incur varying penalties with different probabilities, 20% chance of $100,000 penalty, 30% chance of $200,000 penalty, and 50% chance of $500,000 penalty, we use the expected value method. We calculate the weighted average penalty amount and record a provision accordingly. To summarize, single most likely outcome method is used when there are limited outcomes. We proceed towards the event with the highest likelihood. And the expected value method is used when there are numerous potential outcomes. We calculate the weighted average of all possible outcomes based on their probabilities. When dealing with variable consideration, IFRS 15 is very clear about its inclusion in the transaction price. The standard states that variable consideration can only be included in the transaction price if it is highly probable that the subsequent change in estimate would not result in significant reversal of revenue. To illustrate, let's consider an example. Suppose I run an advertisement company and our work involves shooting an advertisement for the client. A client approaches me and agrees to a fixed consideration of $500 for an advertisement shoot. Additionally, the client states that they will conduct an independent review of the advertisement, and if the advertisement receives a 3-star rating, they will provide an additional bonus of $200,000. Now, in this contract, the fixed consideration of $500 is straightforward and included in the transaction price. However, the additional bonus of $200,000 is variable consideration, contingent upon receiving a 3-star rating for the advertisement. In this scenario, we need to estimate the likelihood of receiving the variable consideration. First, we determine whether to use expected value method or the single most likely outcome method. Here, there are only two outcomes. Either we receive the 3-star rating and the bonus, or we do not. Therefore, we use the single most likely outcome method for our estimation. For instance, if there is a 40% chance of receiving a 3-star rating and 60% chance of not receiving it, we cannot assert that it is highly probable that variable consideration will be received. Consequently, we do not include the $200,000 bonus as a part of the transaction price because there is a significant risk of revenue reversal due to the uncertainty in achieving the rating. However, if there is an 80% chance of obtaining the 3-star rating, indicating it is highly probable that we will earn the variable consideration, we would include the $200,000 bonus in the transaction price. The key criteria here is that variable consideration can be included in the transaction price only if it is highly probable that the change in estimate will not result in significant reversal of revenue. While our discussion and estimates are based on probabilities, it is practically possible that estimates might change in future, that estimates might change in reality. If an estimate change occurs leading to a reversal of revenue, it is treated as a change in accounting estimate, and such changes are accounted for prospectively, meaning thereby they are applied to the future financial statements without retrospectively adjusting the past financial statements. To summarize, variable consideration can only be included in the transaction price if it is highly probable that the subsequent change in estimate will not result in the significant reversal of revenue. Estimation method includes the single most likely outcome method used when there are limited outcomes and the expected value method used when there are numerous potential outcomes. And changes in estimates are accounted for prospectively, ensuring that the financial statement reflects the most current and the accurate information. By adhering to these principles, we ensure that the transaction price actually reflects the consideration we expect to receive, minimizing the risk of revenue reversal due to change in our estimates. Now, let's look at some practice questions related to variable consideration to understand its practical application. We have an illustration in front of us. Tommy Company enters into a contract to build an oil rig for $100 million. If the oil rig is not completed on time, there will be a $20 million penalty. Tommy Company states that they have built similar oil rigs before and there is a 90% chance that the oil rig will be completed on time. The requirement asks us to briefly discuss how Tommy Company should measure the transaction price. Let's evaluate this contract. Out of the $100 million transaction price, $80 million is fixed, meaning thereby whether you build the oil rig on time or not, you will still receive the $80 million. And the remaining $20 million is variable, contingent on whether you completed the oil rig on time or not. So initially, I have bifurcated the $100 million transaction price into $80 million fixed consideration and $20 million variable consideration. Now, for estimating this $20 million variable consideration, which method should we use? The expected value method or the single most likely outcome method? In this scenario, we have only two possibilities. Either the oil rig will be completed on time or it won't. If the oil rig is completed on time, we will receive the $20 million, and if not, we won't receive $20 million. This means we should use the single most likely outcome method for our estimation. Tommy Company states that there is a 90% chance that rig will be completed on time. A 90% chance means it is highly probable. Highly probable means we will complete the rig on time and won't have to incur the $20 million penalty. This means we are entitled to $20 million, so our transaction price will be considered as $100 million. Let's read its solution. It says there are two possible outcomes, $100 million if completed on time or $80 million if not completed on time. The single most likely amount method better predicts the amount of consideration. Due to significant 90% chance that the oil rig will be completed on time, therefore the transaction price should be $100 million. Let's consider another illustration to further understand the practical application of variable consideration. On 1st November 2018, an entity entered into a contract with a customer to build an asset for $1 million. The contract includes a penalty clause stating that if the construction is not completed within 3 months from the date of contract, a penalty of $100,000 will be applied. By the year ended 31st December 2018, the contract is 60% completed and the entity expects that the construction will not be completed by 31st January 2019. However, the construction is actually completed on 28th January 2019. In this scenario, the total transaction price of our contract is $1 million. However, if we break down the $1 million, we have $900,000 as a fixed consideration and $100,000 as a variable consideration. The fixed consideration is $900,000 because regardless of the timing, we will receive this amount. And the $100,000 is variable consideration contingent upon completing the construction within 3 months. By the year end, our contract is 60% completed and we do not believe it will be completed on time. Therefore, variable consideration will not be included as a part of transaction price at this point. Our contract transaction price would be $900,000, and since the contract is 60% completed, we will record revenue of $540,000 by the year end. Journal entry on 31st December 2018 would be contract asset or contract receivable would be debited by $540,000 and revenue will be credited by $540,000. By 28th January 2019, the construction is completed. Even though we had initially estimated that it would not be completed on time, but since the construction was completed within the 3 months period, the variable consideration will now be included in our contract transaction price. Thus, the total transaction price is $1 million. And we have already recorded revenue of $540,000 by 31st December 2018. Therefore, the remaining amount of $460,000 will be recorded as revenue on 28th January 2019. Journal entry on 28th January 2019 would be contract asset or contract receivable would be debited by $460,000 and revenue will be credited by the same amount. In this scenario, we see a change in estimates. We account for this change prospectively, meaning we adjust our financial statements going forward rather than retrospectively adjusting the past financial statements. Thus, we record the additional revenue of $460,000 on 28th January 2019. By understanding this illustration, we can better appreciate how variable consideration affects revenue recognition and how changes in estimates are accounted for in practice. Next, we have another illustration to review. An entity entered into a contract with a customer to build a customized asset. The promised consideration is $2.5 million, but this amount will be adjusted based on the timings of the completion. Specifically, for each day after the deadline the asset is incomplete, the promised consideration is reduced by $10,000. On the other hand, for each day before the deadline the asset is complete, the promised consideration is increased by $10,000. Additionally, upon completion of the asset, a third party will inspect the asset and assign a rating based on the matrices defined in the contract. If the asset receives a specified rating, the entity will be entitled to an incentive bonus of $150,000. The requirement is to determine how to estimate the variable consideration in the above contract. In this contract, there are two variable consideration. Number one is the incentive or penalty for timely completion. In this case, there could be numerous outcomes based on the timing of completion. The asset could be completed 1 day early, 2 days early, 3 days early, and so on. Or it could be completed exactly on time, or it could be completed 1 day late, 2 days late, 3 days late, and so on. Given the numerous possible outcomes, we will use the expected value method to estimate the variable consideration for this part of the contract. This involves calculating the weighted average of each possible outcomes based on its probability or expected chances. The second variable consideration is the performance incentive bonus. In this case, there are only two outcomes here. Either the specified rating is achieved, resulting in $150,000 bonus, or the specified rating is not achieved, in which case the bonus will not be received. For this, we will use the single most likely outcome method to estimate the variable consideration. We will proceed according to the outcome with the highest probability. By applying this method, we can accurately estimate the variable consideration and include it in the transaction price as per IFRS 15 guidelines. So, we have covered the concept of variable consideration, including how to estimate it using the expected value method and the single most likely outcome method. Through various illustrations, I hope I was able to explain this concept in detail. Let's conclude our today's discussion here. Thank you.